Assalamu alaikum wa rahmatullahi wa barakatuh. Inshallah, in a minute, we are going to start the session. Doctor is trying to join us in a minute, inshallah. Assalamu alaikum wa rahmatullah. Dr. Auwal, welcome to the platform. I think you can hear me now.
Yes.
Alhamdulillah.
Can you hear me too?
Yes, your voice is clear. So we are starting now. Okay, Bismillahirrahmanirrahim. Alhamdulillahi Rabbil Alameen. Wassalatu wa atammi taslim ala nabiyyina Muhammad sallallahu alayhi wa sallam wa ala alihi wa sahbihi ajma'in wa tabi'ina lahum bi ihsanin ila yawmiddin. Amma ba'd. Honorable Dr. Auwal Adam Saad, our guest speaker, our online guest, dear brothers and sisters, this is our immense pleasure to welcome you all to today's session entitled FinTech and BigTech Credit, Shari'ah and Regulatory Review. And today's topic will be discussed by Dr. Auwal Adam Saad, inshallah. As part of our regular activities and events of Islamic Economics Association, Nadil Iqtisad Islami, at the Faculty of Shari'ah and Islamic Studies, Kuwait University. Today's session is also very important for the students and researchers of Islamic finance and for the professionals, experts who are trying to promote Sharia compliant finance models. As you know, our Nadil Iqtisad Islami is conducting courses, lectures, workshops, trainings, both in Arabic and English languages to promote these Sharia compliant Islamic financial models and modules globally. And it's having now a vital role globally to fulfill the requirements of Islamic financial models and Sharia framework. So let me introduce today's speaker, Dr. Auwal, who is assistant professor at the Institute of Islamic Banking and Finance, International Islamic University, Malaysia. And he completed LLB Sharia at the Islamic University of Medina, Kingdom of Saudi Arabia. He also completed his master's in comparative laws and Doctor of Philosophy in Law from Ahmad Ibrahim Kulliyah of Law, International Islamic University, Malaysia. His PhD research was on Sukuk assets regulations in Islamic capital markets. He is an alumnus of the Cambridge Judge Business School, where he studied FinTech innovation, disrupting the financial landscape in the class of 2021. Prior to his appointment at the IIUM Institute of Islamic Banking and Finance, he has been a lecturer at the Faculty of Management, University Science, Malaysia, USM, and Ahmad Ibrahim Kulliyah of Laws at IIUM. His areas of research are Islamic FinTech, Islamic Banking and Finance, blockchain, Sukuk, smart contracts, Islamic capital markets, Islamic economics, Islamic commercial law, business law, crypto assets regulations, and all applications in Islamic banking and finance. So let me invite Dr. Auwal Adam Saad to deliver his talk entitled FinTech and BigTech Credit, Shari'ah and Regulatory Review. Please welcome.
Thank you very much indeed, Dr. Mohammed, for this very generous introduction. Thank you very much. Can you allow me to share my slides, please?
You can share slides, I guess. Yes.
Yes. Bismillah wa salatu wa salamu ala rasulillah wa ala alihi wa sahbihi wa man walah. سبحانك اللهم لا علم لنا إلا ما علمتنا إنك أنت العليم الحكيم. رب اشرح لي صدري ويسر لي أمري واحلل عقدة من لساني يفقهوا قولي. أما بعد، الاقتصاد الإسلامي في جامعة الكويت. And all, I would like to greet you with the Assalamu alaikum wa rahmatullahi wa barakatuh. Thank you for giving me the opportunity to speak credit, looking into the Sharia and regulation. That my voice is clear, inshallah. And my respect, Dr. Mohammed. My name is, sorry, my voice is clear, right?
Yeah, but sometimes it's being hanged.
Is it?
Yes, yes.
Okay, let me just mute the video, I think. Now it's okay, right?
Yes, yes.
Okay.
Yeah.
So I'm sorry, I think we have to do it without the video.
No problem, Doctor, inshallah. Maybe during question and answer sections, we can see your video, inshallah.
Okay, inshallah. So I'm from IUM Institute of Islamic Banking and Finance, International Islamic University, Malaysia. I have the pleasure to discuss this topic with you today, FinTech and BigTech credit, Sharia and regulatory review. To give this topic what it has to be given, let me first start with the definition. What is FinTech? But before then, this is the content of what we are going to look into today, inshallah. We are going to look at the FinTech and BigTech regulation. And first, we need to understand what is FinTech and what is BigTech. So a few definitions could be explored. And then we're going to look at the FinTech regulations in Malaysia, the recognized market and IEO regulations. And then Sharia products related to the FinTech credit, Islamic P2P financing and investment, commodity murabaha as a product, and then new platforms for Islamic markets, such as the blockchain sukuk platforms. I think with this we can conclude the talk, inshallah. So I pray that Allah subhanahu wa ta'ala will guide me and also allow me to say what is good and prevent me from saying what is wrong. Islamic FinTech. There are a lot of definitions related to the Islamic FinTech, and many researchers and academicians have come up with the many definitions. I would like to define this very important topic as the use of innovative technologies in the design and delivery of Islamic financial products and services, which includes peer-to-peer Islamic investment, tokenizing Sharia compliant assets, shares, sukuk, and Sharia compliant crypto tokens, NFTs, or digitizing Islamic social finance processes such as zakat, waqf, charity crowdfunding, and other related Islamic products with full adherence to the Islamic law and related Sharia standards in line with the maqasid al-Sharia. The definition look at very lengthy, yes, I agree with that. But I think it's very important to mention many of such things which are actually connected and related to the Islamic fintech. But today, I'm gonna look at the fintech credit. So when we talk about fintech credit, there are a few definitions and examples that are very important. But to understand what is fintech credit and big tech credit, we also need to understand how critical is the credit market is today. Credit markets around the world are undergoing a transformation. While banks, credit unions, and other traditional lenders remain the main sources of finance for companies and households in most countries. And also, there is capital market playing an important role in these cases. However, there are new intermediaries which have recently emerged, in particular digital lending models. These digital lending models are peer-to-peer, P2P marketplace lending, and invoice trading have actually grown in many economies in the past decade. And this is very, very important. So that means fintech and big tech are actually involved in the credit market. And that means so much in the financial market. Here we can see the few definitions of fintech and the big tech credit. Some scholars look at fintech as technology that enable innovation in financial services that could result in new business models, applications, processes, or products. So that means fintech have to come up with a new innovation which contain new business models, new applications, and new products in the market, which is actually different from the conventional financial market models or business models. So in this example, we can see the kind of payment gateway companies such as Stripe, PayTM, and so on. In Malaysia, we have PayHalal, which are actually Islamic-driven payment platforms. Fintech credit. Fintech credit are actually credit activity facilitated by electronic online platforms that are not operated by commercial banks. So all the P2P platforms are actually on this category. So you can call it P2P or marketplace lending and so on. Big techs. Big techs are actually large companies whose primary activities is digital or digital services rather than financial services. So in this category, you can see companies such as Amazon, Ant Group in China, Google, Grab, M-Pesa in Kenya, Alibaba, even Facebook, Apple, and so on. In the fintech credit, we have the company called Zopa. Zopa is actually the first company to spark or to start the P2P lending in the UK. And then the market grows to the US, where we have companies such as Lending Club, Funding Society, Prosper, who took up the market. And then the market grows again to reach China, where we have very big tech companies who have actually took the throne, took actually this market to continue. So we can see the growth of the market in China is currently actually greater than any other country in the world. So we can see the starting point from the UK, then it goes to the US, and then China. Currently, these are the actually main fintech credit and also big tech credit markets in the world. We are going to see this in some details, but how these big techs are different from fintech. I think this is very, very important because big techs actually large companies that have their primary activities in digital services. So what they do primarily is like, data related activities and many other things which are actually related to technology based kind of business. So when these big companies or these big tech companies tap into the credit market, that means a lot. So the question here is how to regulate the big techs and how the regulation of fintechs have actually gone so far. Is regulating big tech actually has to be similar to other financial services regulation. So this is very, very important. When you have a company like technology company like M-Pesa in Kenya trying to give loan to the customers. So how the regulators respond to such kind of activities? When you have Facebook, for instance. So we are going to look at the uniqueness of these big techs and what are the relevant approach to regulate them, and also what that means to the financial market. And of course, the Islamic P2P platforms. So we can see the growth of fintech credit in actually in many European countries. From the beginning, since 2014 until 2014, this report is showing how this actually market has been growing. And most of the lending in the Europe, you can see in the New Zealand, also India, the United States, Korea, France, it's mostly in the consumer lending. Then we have business lending, which are actually involved with the businesses that are getting actually money from these fintech or big tech companies. And then invoice trading and real estate. The growth of fintech and big tech credit. Many studies estimated that the flow of these new forms of credit reached almost 795 billion globally. However, you can see that big techs are actually larger and bigger size than the fintechs. So you can see 223 billion fintech credit, but 572 billion for big tech credit. And China, the United States, and the United Kingdom are the largest markets for the fintech credit, but not big tech. Big tech credit is growing faster in China, Japan, Korea, Southeast Asia, and some countries in Africa, as well as Latin America. Some country panel regression research shows that this kind of lending is more developed in countries with high GDP per capita, but at a declining rate, where banking sector markups are higher and where banking regulation is less stringent. So these are the areas where these kind of markets are actually growing. Also, some studies show that fintech credit is larger where there are fewer bank branches per capita. So when there are fewer bank branches per capita, the growth of fintech credit is more realistic. And also fintech and big tech credit are more developed where the ease of doing business is greater. And the presence of investor protection is actually investor protection disclosure. Also, fintech and big tech credit are more efficient in the country where the efficiency of the judicial system are more advanced and the bank credit to deposit ratio is lower. And also where bond and equity markets are more developed. So, of course, such countries like Malaysia and other countries in the Southeast Asia, the Middle East, could actually have a good, actually good potentials for this particular market. Because most of these jurisdictions, they have actually a very efficient judicial system, which is more advanced, and the bank credit to credit ratio is mostly lower, and where bonds and quick equity markets are more developed. So in terms of Islamic capital market, in terms of Islamic fintech credits, the development of Islamic capital market in Malaysia is one of the largest. And that means the fintech credit in Malaysia could be one of the good opportunities. Key differences between fintech credit and BigTech credits. Fintech credit, the models were originally built around decentralized platforms where individual lenders choose borrowers or projects to lend to the projects in a market framework. So P2P platforms, normally, if you get into this platform, you will see how they arrange it into two different categories. The first, where if you are an investor, you want to invest in a particular company or personal financing. So you can actually enroll and get your profile ready for the as an investor. And then there will be another, if you are a person who is looking for a loan, or a company that's looking for a loan, you'll actually register differently and providing different information. So today, many of these companies are actually very fast in giving loan because of the data they have. And they are actually very, giving the loan, which is actually totally different from the traditional way of giving loan. So you can see now many people or many businesses, they prefer to go into these platforms than go into the traditional bank to get funding. So these platforms help to solve problems of asymmetric information, both through their screening practices and by providing investors with information on the risk of the loan and other borrower characteristics. But this fintech credit, their core business of fintech credit is actually remains to be financial services. So even though they are actually doing this, they are doing only something that is related to the financial services. This is very important. Why? Because big techs are different. So big tech credits, they have a range of business lines, of which lending represents only one. And normally, this one is small one compared to their core businesses. So you can see their core businesses is more larger, bigger, and actually giving them maybe more return than the credit market that they just have taken. But these firms, they have existing user base, which facilitates the process of onboarding borrowers. Big techs, they have a lot of advantages. They have the database that they can actually easily access the lenders. They understand the market very well, better than the fintech credits. And they can use large-scale micro-level data on users, often obtained from non-financial activities, because they are actually into data processing business. So it is easier for them to get such kind of information to mitigate asymmetric information problems, which fintech credit are very, very difficult for them to do that. These are some advantages of big tech companies. The large volumes of information allow big tech firms to effectively measure loan quality and potentially reduce loan defaults. It is also possible that they could raise problems of price discrimination. This is what some of the research are actually suggesting. Big techs can use their knowledge of consumer preferences and obtain through their other business areas, such as consumer spending habits and creditworthiness, to offer financial services to customers who may be underserved by traditional lenders. So the economic and social benefits of financial deepening can be compelling. And big tech companies are almost present everywhere across jurisdictions. This is another big opportunity or advantage for these big tech companies. You will find them almost everywhere. Google, you find Google in the Southeast Asia, in the Europe, in Africa, everywhere. Apple, is everywhere. So that's the advantage that these big tech companies are actually having. And they can actually, once they enter into the financial market, or they started to give credit to the people or businesses, that means a lot to the banking sector, as well as financial sector. So here we can see this kind of companies who are actually active in 31 countries as of 2019. You have Airtel. You can see some companies, some big tech are actually communication companies. You have Amazon, Alibaba, you have Apple, you have BCash, I think in Bangladesh, you have Facebook, you have Google, you have Grab, and so on. When Grab started to talk about, or to come up with, to facilitate loans for its own drivers, sorry, not Grab, the Uber. So a lot of questions started to be asked actually. So is Uber now coming into the credit market? So when these companies actually entered into the credit market, there are a lot of things to be learned and how to regulate these particular companies. We also have MTN, which is existing in Africa, in Nigeria, for instance, also started to do the same. We have M-Pesa in Kenya and East Africa, which is actually doing the same, lending people money, something that the banks should be doing. So if these companies come into being and they started doing, entering into the credit market, there are a lot of things that it's going to be happening in the market. So that's why the regulators, they have different approaches in regulating this kind of activities, which we are going to discuss, inshallah. So as I told you earlier, the largest market is China. So both in big tech and FinTech. China has been actually very active in both FinTech and big tech credit. And China is the largest in this, and big tech companies like Alibaba, Ant Group, Tencent, Webbank, they are actually doing the same thing. And you can see their platforms generating almost 363 billion in 2018. And also 516 billion for big tech in 2019. So this covered wide range of borrowers types, from small businesses on Alibaba's platform to smartphone-based consumer loans. So the starting point is from the small businesses, and then going to even rural student loans. So also Ant Group, China in particular, were able to make use of the existing or extensive payments data that they have from their mobile payment services to price credit. So you can see the transformation going little by little, starting from their core business, which is payment services, then transform into the credit price. However, there are a few defaults reported in China between 2014 to 2017. This market by 2018 and 19 was actually hit by failures, platform failures, as well as defaults. So you can see platforms from 3,600 FinTech credit in China, it comes down to only 343, which are actually operating in China by 2019. So this is very important. Also, there are a lot of defaults in this market, and which China actually realized many of them. USA is the second largest in FinTech credit. And the market in the US is lower in terms of big tech. Although US has a lot of big tech companies, but we can see few participation based on the data available to show that the involvement of these big techs into the credit market. But there are few, as you can see, 1 billion is been raised through this lending by Amazon. And also Apple launched its Apple Card in cooperation with Goldman Sachs, which had outstanding balances of almost 7 billion. So this is also very important. As we can see, US has a lot of big tech companies. So when these companies started to do the same, that means a lot to the financial market. So Japan is the second largest in terms of big tech credit. The second largest market for big tech credit is Japan, which has almost 23 billion of lending in 2019. This company, Rakuten, has offered a suite of official financial products since 2013. And it includes payments, transaction lending, credit card issuing, and acquiring mortgages and insurance. And then the social media company Line offers consumer lending through a joint venture with Mizuho Bank. So these are some practices that are recorded actually in Japan, where big tech are actually very active. Regulating fintech and big tech credit. Fintech and big tech credit activities fall into non-bank credit. So these types of credit facilitated by online platforms rather than traditional banks or lending companies are referred to as debt-based alternative finance or fintech credit. Moreover, in this past few years, many large companies whose primary business is technology big techs have entered credit markets, lending either directly or in partnership with financial institutions. So some big techs are actually partnering with other financial institutions to conduct the credit service. We have few issues in regulating big tech credit. One of the main issues is that these are large multinational technology-based companies with actually extensive customer networks whose core business could be in social media, telecommunications, internet search, and e-commerce. And they are present in each and every continent and in almost all or most of the jurisdictions, if not all. The business model of big techs leverages three factors: the data they already have on consumers, aiding big techs to understand customer needs better, the advanced analytics they use to deepen the understanding further. Normally they use machine learning for this, and the reliance on strong networks effect from leveraging their large consumer base. So the expansion into financial services can happen very quickly, as network effects drive interaction, user activity, and the generation of ever greater amounts of data. So there are some regulatory concern here. Here we can see the cloud services as an example. Cloud is the virtual delivery of computing services that powers the operations of diverse entities across financial services. But you can see the range is wide, yet there is a strong dependency on only few critical providers. This report from Bank of England in 2020 estimated that more than 70% of banks, 70% of banks, and 80% of insurers rely on just two cloud providers for infrastructure as a service. So if only two providers or two cloud service providers, only two big techs provide 70% service to the bank, That means a lot. And globally, 52% of cloud services are provided by just 2 big tech entities, while more than 2/3 of services are provided by 4 big techs. So this data is very, very important. So that means these big techs, they have a lot of information on the banking and financial sector. And when they come into the credit market, they want to make a big difference. The concentration or the reliance of the financial sector on the services provided by FinTech is actually obvious. And failure, or even one of these firms, let's say one of these 2 firms has a problem or fail in its own services, that could create a significant event in financial services. And this will come with a negative impact on markets, consumers, and financial stability. That means the importance of these services means that in some respects, big techs may be already too critical to fail in some. And FinTech firms generally are not yet systemically significant because their market share of financial services is actually very low, or in most jurisdictions, it's not yet material. But big tech credits different regulatory challenges. Big tech credits means different regulatory challenges. So there are big tech regulatory challenges here. We can highlight 3 of them. Though these big tech, their isolated financial activities might not be systemic, but they could cumulatively generate significant financial risk, especially because this could be scaled up very rapidly. Very rapidly, they can actually scale up because of their capacity, strength, and the data. And this could also magnified by their interlinkages with regulated financial entities, such as partnerships that they have with other financial institutions to originate and distribute financial products. They could also generate risk as they carry out a systemically important activity additional to financial services, such as the cloud service. These are some approach in terms of regulation. Same activity, same risk, same regulations. Will this work for big tech? So the principle of same activity and same risk, same regulations may seem very reasonable approach, but it may not be sufficient in addressing the potential stability implications of big techs. And this could provide big techs with a competitive advantage through the benefit they can gain from a less comprehensive regulatory framework. That's why you can see FinTech, big techs are actually excelling in many countries or in many jurisdictions that have less comprehensive regulatory framework. Many existing regulatory frameworks like open banking that aim to facilitate competition may have unintended consequences. And many researchers actually show that they could create a one-way flow of data that allows big techs to capture a large market share. However, there are some important cautions here. The approach must define activities very precisely, which is likely to create regulatory arbitrage opportunities, as it may not be able to capture rapidly changing and hard to define FinTech activities. It's also not very effective for cross-border activities. So same activity, same risk, same regulations might not be very effective for cross-border activities unless global regulators adopt consistent regulations and unless international agreements allow for cross-country enforcement actions. Otherwise, these big companies can actually migrate from one place to another. A mixed approach. So regulators are actually monitoring, and the monitoring and risk identification should focus primarily on economic functions and activities. But the regulation and supervision should focus on entities. So a mixed approach could be based on the entity-based approach, but the requirements will be tailored to the activities that the specific entry or group is engaged. So entity-based approach could actually make difference in terms of regulating big tech companies. Islamic fintech or Islamic fintech credit or Islamic P2P platforms. This is also one of the growing area in terms of Islamic finance is concerned. And we can see a lot of development of Islamic fintech credit or Islamic P2P platforms across the globe. And especially in the Southeast Asia, we can see the presence of these platforms in Malaysia, Indonesia, Singapore, and other, as well as Saudi Arabia, and many other countries, such as UAE, and even in the UK. That means it's very important to understand how this Islamic fintech credit work and what is the importance of their activities in terms of Islamic finance is concerned. Before we go into that, this is some reports that actually show some scores for countries in terms of Islamic fintech is concerned. So you have the gift index shows 64 countries with 19 indicators, 5 categories, which shows Malaysia ahead, then Saudi Arabia, Indonesia, and so on. Malaysia has the regulated few fintech or fintech companies that are actually on P2P, having P2P business models. So we can have Microlink, which has both conventional and Islamic P2P business plan or business models. And the good thing about these Malaysian companies, COP-Bay is actually having reported that since 2020, it has maintained a 0 default. Since then, 2 years now. So that means the risk management or the Islamic risk management followed by these particular platforms is quite very good, and they are actually yielding a lot of results with having no defaults in the Islamic P2P markets in these platforms. And also we have Ethis, we have Pay Halal that are actually active. Ethis is in equity crowdfunding. It's an equity crowdfunding platform that recently actually get over 20 million Shari'ah compliant seed fund, and with the joint venture with the joint fund invest in Shari'ah compliant startups globally with an initial geographic focus in the MENA as well as Asian region. The Islamic product that been utilized by this or most of these fintech companies could be seen as commodity murabah. Commodity murabah, where the platform, the P2P platform, will operate as a trust account, will provide a trust account, and then you have the registration of onboarding of the issuers and also the investors registration, and also the commodity sale and purchase took place. And since this is a sale-based kind of contract, that means it's ending with the debt. So it's a debt-based kind of transaction. So this actually could have similar consequences with the other credit or other fintech credit that we have discussed earlier. Malaysia or Malaysian Central Bank has the concern on what is called buy now, pay later, which is a new phenomenon that actually comes into being. Malaysia is currently working on the formation of a Consumer Credit Act with the aim of strengthening protection for credit consumers in Malaysia. And this act seeks to provide a comprehensive framework for regulating the conduct of entities carrying out the business of providing credit to credit services to such consumers, with an immediate focus on those that are not currently subject to direct regulation by any authorities. So Malaysia is very concerned about this, and this is the statement of the central bank governor on BNPL. Regulating the fintech market, also I want to look at the Malaysian regulation. It's called recognized market. So in the recognized market, you have few categories. You have P2P financing. And then this actually particular regulation provides that all P2P operators must be locally incorporated, and they should have a minimum paid up capital of 5 million ringgit, Malaysia. And also you have the digital asset or DAX. DAX regulation is actually similar to P2P, which also have the operators must be locally incorporated and have a minimum paid up capital of 5 million. Equity crowdfunding platforms, also they have similar regulation. Also, we have the PCP, which are actually property crowdfunding. This one, the shareholders funds has to have 10 million, of which 5 million must be set aside and maintained in a segregated bank account at all time. So this is to have the maximum, protection for the investors. And also we have e-services. E-services mean an electronic platform which arranges or facilitates the sale, purchase, or subscription of a particular market product. So for this one, the Malaysian regulator make it 500,000 as a minimum paid up capital for e-service. Now, so then we go to, sorry, Dr. Muhammad.
Yes, doctor, yes.
We still have time, right?
Yes, we do have, yeah. You can continue, inshallah, no problem.
So we have also this particular regulation for IEO operators. IEO means initial exchange operators. As everyone knows, ICO is actually prohibited and not allowed in Malaysia, but initial exchange offering are allowed based on this particular regulation. So the first must first be registered as DAX, as we discussed just earlier. Any IEO operator has to register as DAX and must have minimum of 5 million also as paid up capital. Managers and directors are fit and proper, and must appoint one responsible person, must secure human and financial resources for operation. The cooling off right. Also, the operator has to have or provide the cooling off right must be given to an applicant who is applying to subscribe a digital token in an IEO, and except for where such applicant is a staff of the issue. The cooling off period must be no fewer than 6 business days, commencing from the closing date of the offer. I'm actually giving you this detailed regulatory framework because Malaysia is actually one of the first countries to regulate P2P and also other fintech operations. Operators' obligation. They must carry due diligence and assessment on every issuer and make the white paper available to the investors via the platform, as well as issuers semi-annual and annual reports are published in the platform. And also must avoid the conflict of interest, obtain self-declared risks from its users. Digital asset custody. They may appoint a digital asset custodian registered with the operator or the SC operator with the SC Securities Commission, or follow a specific guidelines on digital asset custody. So some companies would like to actually have a third party for the digital asset custody. Some of them, they want to do it by themselves. So if they are going to do it by themselves, they have to follow the guidelines, digital asset custody, which is available. And then if they want to use the existing custodian, who is registered with the Securities Commission, they can also do the same. And then outsourcing information. This is very, very important in digital markets. The operator must provide SC within 2 weeks prior to entering into any outsourcing arrangement. So the operator must within 2 weeks notify SC or any agreement with service provider or subcontract that may affect the IEO operator. And issuer must not be hosted concurrently on multiple IEO platforms or on an equity crowdfunding or P2P platform. So these are some very extensive regulation on this. And also we have the maximum quantum of funds permitted to be raised within any continuous 12 months. So this period of 12 months subject to a ceiling of 100 billion. So this is also the issuer's requirements for digital asset offering. So the issuer should be Malaysian incorporated company with its main business in Malaysia, including private and public listed, exempt private and public listed, and only raise funds through IEO and not through other means. And it has to have 500,000 paid up capital and shareholders fund of 500 maintained. And 2 of its senior managers are present in Malaysia and fit and proper at all times. And then you have the white paper submission content, and the content has to include a brief on directors, senior managers, project objectives, the kind of digital tokens, sustainability, business plan, and so on. And then issuers obligations has to comply with the requirements, accurate documentation, retain documents for 7 years, do not change the utilization of proceed until or unless prior token holders approval with 70% vote. And this is very important. And then the reporting and auditing, you have the marketing and promotion, and then the power of the SC on top of all that. So SC has the power to impose additional requirements and impose directions anytime to directors, managers, and the activities of the issuer. In conclusion, BigTech credit is actually achieving economically significant scale in China, Japan, Korea, and also East Africa, and even some of the West African countries. And that means a very notable financial inclusion will be actually seen. But policymakers may need to access and actually weigh the efficient loan supply potential in their economies against issues of discrimination, competition, and privacy when deciding which types of credit to encourage, FinTech or BigTech credit. Mixed regulatory approach might be more relevant to BigTech. The regulatory agency should work in close partnership with sectoral regulators and agencies that oversee data privacy, competition, consumer protection, and financial integrity. Islamic financial institutions, Islamic fintechs, and other regulated financial services providers might have better protection and stability in the future if big techs are properly regulated. Before we end this, let me just share with you some anticipating new platforms for Islamic markets, especially when it comes to ICM or Islamic capital markets. There is a lot of discussion on blockchain sukuk initiatives, which actually could be seen, or some reflection could be done with the previous discussion on the regulated fintechs. So for instance, we have the similarities, for instance, to P2P and DAX platforms when it comes to the blockchain sukuk or tokenization of sukuk in the Islamic capital market. So also the compliance could be relevant, similar. The paid-up capital also could be similar, and also the issuers and credit check, which actually the normal process when it comes to the sukuk market processes or issuances. So the issuers, credit check, and so on. Also, we can have the investors check, the AML KYC, for instance, AML KYC, anti-money laundering KYC, and so on. And also the Sharia compliance. It has to be following the specific sukuk regulations. Here are some features of traditional sukuk to be observed when it comes to the platform that actually determined to observe or to tokenize sukuk or to create sukuk on blockchain technology. So considering the primary market, the tokenization process will be there, will actually be implemented. And also the Sharia issues related to the asset that is involved in the sukuk market should actually be observed. And then the KYC, the sukuk legal documentation processes, trust deed, and all these legal documents should be actually looked into when it comes to the tokenization process as primary market. And also the sukuk secondary market should be either non or tradable sukuk. The Sharia issues involved, the currency issues, the money laundering issues, investor verification, KYC, sell-based or equity-based to be discussed here when it comes to the secondary market. And also the maturity, the closure of the sukuk, and the end of the transaction, the surplus amount, for instance, the tokenized sukuk, how it's going to be dissolved, and then the tokens issues, the generated tokens, the face value, the market value, shortfall, and so on. These are the many issues that could be actually discussed. And also when it comes to the crypto or the tokens that have been utilized within the platform, the exchange that happens, how to formally regulate it in terms of relevant to the current regulation or existing regulation of Islamic or of the FinTech, especially in Malaysia as a recognized market, as we discussed just earlier. I think this is the end of my session. Thank you so much. If you have any question, then we can, inshallah. So thank you so much for giving me.
Thank you. Thank you very much, Dr. Auwal, for this wonderful presentation on Big Tech and FinTech. And I believe our online guest, and those who attended in the classroom, you enjoyed the class. And for your information, this lecture is also has been recorded in our official channel in YouTube. So if you want to rehear the lecture, you may refer to YouTube channel, inshallah. So now we open the floor for questions or comments. If you have any questions, you may write in the question box, or you may raise your hand. We'll switch your microphone for you, inshallah. Regarding the presentation slides, yes, yes, inshallah, when doctor will send the slides to us, we'll give you the link in our official pages and also in Twitter, as well as in the YouTube channel, inshallah. Thank you very much. Yes, there are two brothers, Brother Shehu Abdul Qadir. Yes, please, you may speak now. Brother Shehu Abdul Qadir.
Okay, thank you very much. A very big thank you for this lovely presentation by Dr. Auwal. It has brought to the fore the future of Islamic finance. Just want to confirm the aspect of big tech in Islamic finance. Do we have some big techs in participating in Islamic finance? Thank you very much for the lovely presentation. It's an eye-opener on what we're going to look out for in the future. Thank you.
Thank you, Brother Shehu. Yes, Dr. Auwal, please.
Yeah, thank you very much, Dr. Sheikh Shehu, for this question. Honestly speaking, I didn't come across any big tech company that is coming up with an Islamic financial product or service yet. But of course, this trend is growing, and we can see the effect of these particular big techs in other economies and jurisdictions. And it's even coming very closer. We can see it in Africa, in many different countries. So that means, of course, it can happen in the very, very near future. And the impact of this big techs could actually affect the Islamic financial services. But at this moment, I didn't come across any big tech application for providing Islamic financial product. Thank you so much for your question.
Thank you, Dr. Auwal. Brother Ali asked about the prospect of FinTech ecosystems in West Africa, especially in Nigeria.
Mr. Ali,
yes.
The prospect of FinTech, actually Nigeria is one of the countries that have a lot of potential when it comes to FinTech. We have very giant and big FinTech in Nigeria, which are actually driving the market in Africa. We have FinTechs actually running billions of dollars in Nigeria. However, there is less participation when it comes to Islamic FinTech in this country. So that means it's a very good area for any business or entrepreneurs that would like to invest in Islamic FinTech in Nigeria. Is going to be a great opportunity. Yes. So I think this is what I would say on Nigeria. Thank you so much.
And do you think, Doctor, these platforms can enhance SMEs access to finance?
Yes, of course. This is what is actually happening. Let me give you one good example. For instance, when you take big tech, for instance, Alibaba, they have e-commerce platform. This e-commerce is actually having a lot of businesses. Many people who wanted to purchase something, for instance, in China, they come through their platform. So they get to know accurately from their data, the most performing SMEs, for instance, the conduct of the businesses. And that's why they actually provide credit for this kind of SME. Why? Because they accurately know how they perform, and they know how to actually mitigate the risk of default and other risks involved. So that's why it's very important when it comes to big tech. They actually have access to data. which is more than other financial institutions, and even more than the fintech themselves. That's why you can see the size of big tech is actually bigger than the fintech, because fintechs are mostly struggling, to access the market. But big tech are already big people. I mean, big companies that already, established. They have other businesses they do, but providing credit is something, external or very small to them. But if you look at it in the market, it's actually huge and very big. And if it leaves open, it's going to actually consume the market, and because these are very huge and big tech companies. Allahu Alam.
Thank you, Doctor. Now, Brother Muhammad Jidda, you may speak now. Brother Muhammad, welcome, please. Brother Muhammad Jidda. Muhammad, Brother Muhammad, are you here? Can you hear me? Okay, Doctor, now we can see that big techs normally taking a global position and are being expanded into financial services nowadays. So do you think these big techs are going to harm banking system in near future?
Okay, in a way, as we discussed in the presentation, in some countries where, it's a blessing for some other countries where they are not really progressive in terms of the, financial inclusion. So when big techs come into being, they actually benefit in search of, financial inclusion. Many of those who are unbanked, they actually come into, into the picture. But the issue is when you have a very good system in a countries, especially the countries with the higher GDP, and then you have these big techs coming in to actually do the same as the banks. This raised a very big concern issue. Some scholars are actually questioning the stability of the banks in the future. Yeah. Some scholars are actually questioning the stability. So this is the big issue actually. So that's why the regulation is very, very important. Big techs have to be regulated in a way that will be very effective, and it will not harm the financial system. Yeah. I think there is one question here. Somebody is asking, what does sandbox stand for? Are you referring, maybe Mr. Basiru is referring to regulatory sandbox? Normally, regulatory sandbox is a way of regulating fintechs or any innovation normally by the central banks. So they provide regulatory sandbox in order to keep the innovation. When you have an innovation and it comes, it's a financial innovation, but you cannot put too much regulation on such innovation. Why? Because it will just die. So the regulatory approach is to create a regulatory sandbox whereby these new platforms or new innovations will be actually there and watched by the central bank or by the regulator. So the regulator will put certain rules and very little regulatory approach and let these platforms grow. So at the time when they grow, then relevant regulation will be actually adopted on them. And that is how the regulatory sandbox work. I hope I answer your question.
Thank you, Doctor. Brother Mustafa is going to speak now. Brother Mustafa, please, you may speak now.
Yes, hello there. Got a question regarding the data oracle that Apple use, Samsung use. Instead of trying to regulate and go after big tech, why you just don't regulate the oracle provider?
Can you come again? Don't regulate what?
Okay. Big tech companies,
Yeah.
they have a large amount of capital
Yes.
based on their ESG criteria. So ESG criteria, these big tech needs an oracle provider. There's a lot of companies of oracle provider. Instead of going after big tech companies and regulate them, why we just don't regulate the oracle provider? You know, if you can regulate the data they get inflow and outflow, then you are restricting them from many things.
If I understand what you really mean, Brother Mustafa, thank you for your question. Actually, big techs, they are blessings to many countries because they actually help, as I just mentioned now. However, you know, as you can see, when they started directly to provide credit, and this is actually banking domain, or this is the bank's domain. So when they come into this, it will actually raise a lot of issues. Maybe now it's okay, but in the future, because these companies, as you said, they have all the data. They have all what it will make them more stronger. And they have certain regulations in terms of data, as you said, yes, they have to follow certain regulations in their own domain. But now they are coming into the credit market. So that's why the regulation is actually very difficult. And the regulator has to be very concerned about this. That's why you can see the pay and, buy and pay later in Malaysia. The Malaysian regulator has a very big concern about that. Why? Because if it grows, it's going to, create a lot of issues. So yes, big techs are already regulated, by data, that they are actually having and their own technology services that they are providing. But on top of that, since they are coming into the credit market, then a maximum or minimum regulation should actually be observed. I think this is my stand.
Okay, thank you. Thank you, Doctor. Thank you, Brother Mustafa. So is there any more question or comment? So we do have this online guest in this Zoom platform, and also we have students in the classroom. So we would like to thank you very much for joining us in this session. I think there's another question from Brother Muhammad. What is the advice for a startup fintech? Yeah, Doctor.
Wow, this is a very big question. Brother Muhammad Jidda. I think the advice, are you referring to general fintech or Islamic fintech? Of course, the advice is to actually have a platform that is, very, security-wise, for instance, as I know, if you are a startup and you are coming into the fintech arena for the first time, you need to prepare yourself very well. So you need to actually study the market very well and study your own business plan, understand the market you are entering into before starting. Also understand the regulatory framework relevant to your business plan. And with that, we say Bismillah and start. Don't wait too much. Don't waste much time. And this is the habit of many startups. So they start and think too much. Just go and analyze, do your own work, do your own check the market, understand the market very well, and then do Bismillah. Allah make it easy.
Thank you very much. Okay, on behalf of Nadil Iqtisad Islami, Kuwait University, we would like to thank our all the guests in this platform and who join us in this session. Thank you very much for your participation, and may Allah bless you all. And our thanks to the administration and management of Nadil Iqtisad Islami, especially our Director General Dr. Auwal and other staffs members for their hard work and for their effort. And our special thanks to our guest speaker, Dr. Auwal Adam Saad, for your this wonderful session on FinTech and BigTech credit, and for your effort. Jazakumullah khairan, barakallahu feekum. Inshallah, we hope to see you again soon in any other session, Dr. Auwal. If you have a concluding remark, please, welcome.
Yeah, thank you very much. I just ask if we have any photo session with the.
Yes, sure. Yeah, we normally take pictures. So you were not in the video, so now I think it's perfect. Yeah. Again, Doctor. Okay, thank you very much. And I'm going to send you these pictures and also certificate, inshallah. So Dr. Auwal, thank you very much for being with us, and we hope to see you again in any other session, inshallah. So my dear brothers and sisters, ila al-liqa ma'as-salama. سبحانك اللهم وبحمدك أشهد أن لا إله إلا أنت أستغفرك وأتوب إليك. السلام عليكم ورحمة الله وبركاته.